Hello, guys, and welcome back. If you're watching this, then I assume you already went through the basics, and finally, you get to understand how you can approach the market and capitalize of it. So, it starts with I'll be discussing on basic market structure. And when I started learning about market structure or trading in general, I was really confusing because like, I remember I had to watch videos over and over again just to get a particular concept. So on this video, I'll try to make it as basic as possible so you all will be able to understand market structure easily. So let's begin. When it comes to market structure, we have three types of structure. We have the uptrend or bullish trend, the downtrend or bearish trend, and then the ranging trend or consolidating trend, or the ranging market, either of them. So now, what is a trend? A trend, when it comes to an uptrend, is a continuous series of movements consisting of higher highs and higher lows. But in reference to a downtrend, it is a continuous movement that consists of a series of lower lows and lower highs, just as displayed on the screen. But when it comes to a ranging trend, on the other hand, it is the movement of the market within two specific areas, and those areas are referred to as support and resistance levels, with the resistance being at the top and support at the bottom. Now that you have a clear understanding of trends, how do you trade them? Well, on a trend, we have both strong legs and weak legs. And on an uptrend, those legs are identified as the higher lows, which also act as support areas or demand areas. So whenever I choose to analyze and probably at that point the current structure is bullish, then your entry or point of interest rather should be from the support or demand areas, which are the higher lows, and then you target the resistance or supply levels, which are also the higher highs as an exit point. And while trading a trend, you should understand that not every higher low can be termed as a strong leg on an uptrend. So, therefore, for a leg to be strong, it has to break structure to the upside. And with added confluence, you can wait for the market to return back to that leg before it continues the buy. And also, this also correlates to a sell scenario on a downtrend. So, the basic idea of all this is that, just as you can see on the screen, we have the higher high, higher low, higher high, higher low. And each time a higher low is formed and it breaks structures to the upside, what does price do? It returns back to the higher low to mitigate it in order for price to keep on going up. So, that is just the basic concept of it. But then how do you trade the ranging markets now? Well, you can look at a range as, let's say, being stuck in a time loop where you try to escape but end up at where you were before. And that is just the movement pattern of a ranging market. So now most people like me see no use of actually trading a range. And I'm not saying you can't trade it, but it's really risky, and despite that, there are still traders that engage only when there is a range in the market. But then it all depends on you. It all depends on the type of trader you are. And if you do insist on trading the range, then there is a safer way rather than engaging in all those noisy movements from top to bottom. And it's a strategy used by many other traders, which is called break and retest strategy. And this involves waiting for price to break out of a range either above or below, and then return to the last leg that caused the break of structure before looking to buy or sell again. And I know this should be the shortest video on basic market structure, but regardless, I'm certain that you're able to get clarity and understanding from it. And know that you mustn't engage on every single move in the market. So always trade in the current direction of the market. And on the next video on advanced market structure, I'll expand more on market structure with theoretical and live chart examples. So see you on the next video.